Great. So I think we have everyone here now. So welcome everyone to this taster lecture for the Postgraduate Diploma in Financial Planning. We're delighted to have you here with us today. My name is Eva Lavin and I'm the Education Manager in LIA. Paul Grimes will facilitate this afternoon session, and Paul has lectured on the programme for the last 10 years, so you're definitely in good hands. And for those who have already signed up to the Postgraduate Diploma, we hope that this gives you an insight into the style of a typical lecture. And then I suppose for those who are thinking about commencing in September or in a subsequent term, this session will give you some more information on what you might expect from a typical lecture on the programme. There is 1 hour CPD available for your attendance at this webinar, and this will be automatically logged to your LIA record. You'll see as well a Q&A box on your Zoom screen, so please use this to ask questions throughout the webinar, and then Paul will answer these at the end. So I'm now going to hand you over to Paul, who will talk to you about the importance of numeracy in financial planning. Thanks, Paul.
And thank you, Eva, and good afternoon, everybody. And again, thanks for joining us this afternoon. In terms of this afternoon session, and I suppose just to position this for you in relation to the post-grad, what I'm going to do is run through this particular topic that I've chosen for today's event, but to use it in a way just to give you a sense of, I suppose, how lectures are organised, and also perhaps to give you some sense of the way material might be covered. It won't be exactly replicating a lecture itself per se. The breadth of what I'm covering today is quite wide. But what would happen in a lecture environment, and I'll explain this as I run through it, is that there are areas and aspects of the material that I'll cover today which in of themselves would make up a lecture in their own right. So what I've elected to do is give you a sense of the breadth of the topics and the way they might be covered. And I suppose maybe just a position for you that at the level that this is at, which is a master's level, quite often the lectures don't in of themselves provide all of the answers. What they do is generate thought, conversation, and allow for disparate views on different matters, and that in of itself is a huge benefit in the nature of what it is that we do, because the reality is the world in which we operate is not a well-defined world in the sense that it's governed by precise rules. That isn't true to say, and so consequently, quite often the challenge for us can be understanding what are the issues that we need to deal with and the unanswered questions, if that makes some sense. So what I'm going to have a look at today is the topic under two broad headers: the attraction of shortcuts, and then from a practice point of view, just examining 5 or 6 examples of where the rubber hits the road. What are the issues around numeracy for consumers, but also for practitioners, and keep in mind that much of the material I go through today, it's applicable to practitioners irrespective of level. So I include myself in this and others who have gone before you and are practicing CFP professionals. It isn't to say that these some of the issues that I disclosed today have been resolved as a consequence of going through the graduate. That isn't the way it works. Okay, so in the attraction of shortcuts. So at its heart, what we're talking about here is 2 different forms of economics. So we have classic economic theory, and we have the more recently developed behavioral finance theory. Okay, so classic economic theory works on the broad principle that the human mind is capable and conditioned to make a decision that optimizes the financial outcome for the person based on their understanding of the problem that's being posed to them. So this sort of notion that the human condition is rational of thought is central to classic economic theory. Now, since the early 1980s, and particularly in recent years, there's been an absolute huge growth in the merging of psychological theory with economic theory, which has taken us to this point of understanding of behavioral psychology and behavioral finance as an extension into the world of finance. And this posits that in actual fact, the human mind is not rational. It is irrational. And so, in other words, it just simply is not true to say that the human mind can work out complex calculations in a heartbeat in order to arrive at a precision decision. And so what happens then is, in lieu of that type of rationality, excuse me, we develop individually what are termed heuristics in the language of behavioral finance. We just simply call them mental shortcuts. So we have rules of thumb that get us around different problems, and those rules of thumb can get us into difficulty, and that's what I want to explore initially with some of the examples that I've thrown up here. So this is a well quoted piece of research that has been used in practice by psychologists down the years. So it has to do with toss of a coin and probability theory. So in other words, toss of a coin, there's a 50% chance of it coming down with heads, 50% chance of it coming down with tails. And I think most people get that and don't have any issue with that. Problems start to arise then when you get a sequence of particular outcomes. So in other words, you get 5 straight, in this case heads coming up, and what happens is we're inclined to then look for and determine that what this indicates is some sort of an outcome that we can now start to predict. And so the probability piece that we started off with, which was an acceptance that it's a 50-50 outcome as to which way the coin will come down, starts to change in our own heads, because what we're seeing is we end up with what can be called overconfidence in terms of what's likely to happen after a sequence of 5 straight heads, and we arrive at a conclusion in most cases that the expectation is the next one will also be heads. But there is absolutely no basis for that in probability theory. It's still the same problem. The next flip of the coin has a 50-50 outcome as to which way it might turn out, and so this leads to that sort of a rule of thumb behavior that I spoke about, which is we think we see sequences that are not in actual fact sequences, and that lead to a change in the probability of a certain outcome changing. This is a prime example of that particular situation, and it leads to one of the biases or heuristics that I mentioned earlier, which is overconfidence in the reliability of information. So this matters in practice. Let me say to you, if you were to look at for example, the behavior of stocks in the stock market, and taking an over-reliance on the movement of particular stocks in a particular direction, and believing that this is a trend that we ought to be able to capitalize on. You could argue similar examples exist in terms of what's been happening with cryptocurrency, what happens with gold from time to time that is separate to what's happening with inflation. So there is plenty of evidence of this type of behavior existing in the financial world, and it causes the implications of these biases is it causes an investment behavior that is flawed, and which leads to the creation of value in the stock market. So you get an imbalance in valuations, and the reality is that professional advisors are consequently better positioned to pick up on these opportunities than perhaps most ordinary investors are. But I'm saying that in the context of just this one example. So this is another example of a behavior-led piece of research. So we have two colored balls, 10 reds, 10 black, put into a bag. And again, it's the same process. We select the ball at random, and what's different with this one is when you get a run of 5 consecutive reds coming out, say for example, what that means is that 15 balls are left in the bag, 10 are black, 5 are red. So the probability outcome has now changed, okay? And so in actual fact, with this particular sequence here, the probability of the next ball coming out is significantly greater that it is going to be black than it is red. We can misinterpret the information again in terms of 5 consecutive reds. Does that mean the next one will also be red, that there's some sort of sequence going on here? And so misinterpreting information again leads us to a type of behavior that is not optimal. And again, we take that into the investment world. That same type of behavior exists in terms of decision making around, you know, whether it's decisions to work or rebalance portfolios because of particular things that might be happening in markets or whatever the case might be. But these behaviors, I suppose it's important to suggest and say they're not something that is limited to consumers or clients. They exist at all levels. So whether it is the professional financial planner, stock analysts, even stock committees, and so part of what we cover on the program itself is a much more in-depth understanding of what these particular behavioral heuristics are, and we examine them under a couple of different headings, including exposure to research on behalf of certain academics down the years that have proven particular points, you know, in terms of how this misbehavior has contributed to fluctuations in market valuations, leading to loss of money on the part of I call them unprofessional investors, and professional investors being the ones that are best positioned to capitalize on those imbalances in valuations. So relating that little piece that we've just covered back to what happens on the program, to be clear, behavioral finance is a key part of the program. We'll cover an element of it in module 1 in terms of the basics. It's obviously then further covered in more detail in terms of the investment or asset management module, because at its heart, behavioral finance has perhaps been the biggest driver in the growth of passive and particularly ETF type structures of investment. At their heart, you know, they are derived from this whole area of behavioral finance, and most of you will be aware, I'm thinking, and if not, we'll be referencing it on the program, of the advice of the likes of Warren Buffett in terms of what would he advise most clients to do with their funds in terms of investing, which is to buy the global index of stocks on the cheapest ETF that you can find, and just hold it in perpetuity. So you know, there are strong views in the industry as to what this all means in terms of active management versus passive management, etc. And that gets covered in far more detail on the asset management module, and indeed the retirement module in itself will cover aspects of that from a funding of retirement perspective as well. Okay, so to another example here. So we have 2 items here, a hurley and a slitter, and so we're saying that the combined cost is €10, and the hurley costs €1 more than the slitter. How much does the slitter cost? And this is a derivative of a piece of research that was carried out in Harvard as part of their behavioral economics program, posited with master's level students over there, and the majority, in their case, it's a baseball bat and a baseball. The majority of people's response is that the cost of the bat or the hurley in this instance is €1, and that in fact is not correct. So the correct answer is €1.05 is the cost of the hurley, and the ball then being 5 cents. Now again, it jumps out at you straight away, but it's a simple example of an inclination to jump in with a quick answer for what appears obvious, but isn't in fact quite so obvious as it might appear when you first read the question. So another example of where we go wrong with rules of thumb informing the decision rather than considered analysis. So they're just, you know, a couple of very simple examples. As I say, we do cover this in quite a bit more detail on the program, and particularly relating the behavioral biases and the exhibition of them into influence on financial market valuations. Okay, so what I want to next look at here is taking some of that and maybe having a look at finance and numeracy and modeling in the context of practical examples that we work with on a day-to-day basis. So these are the examples that I will chat through over the next 20-30 minutes or so. And as I said, or as Eva has said at the outset, if you've got any questions, I'll be happy to work through them at the end. Just use that Q&A function, and I'll pick them up at the very end. So let's have a look at the very first one, and this is very topical. Anybody who's been involved in markets in Ireland in particular, and how the housing situation. Indeed, there's one noted finance commentator with one of the main dailies who has repeatedly used this particular rule of thumb incorrectly for the last 10 years, and is only now turning out to be correct. So the example here is you lose 40% on your investment in year one, and the following year you make 50%, and so therefore the mental maths outcome is well then I have to be ahead by 10%, but that's not true. You're actually still behind to the tune of 10%. So if we work through, say, an example with easy maths, say 100,000 is invested, lose 40%, which is 40,000, leaves me with 60,000 still in the investment pot. If I get a 50% return the following year, that will give me a 30% investment return, which takes my investment back up to 90,000. So I'm still 10,000 short of the original 100,000 that I invested. So this is a classic one that is constantly misunderstood by clients and indeed by, can I just say, most advisors in terms of understanding what's going on in terms of averaging out percentage returns is not correct in most cases. So the classic one, as I said, day one in this one is the property valuations in Ireland and whether they're back up. We're only getting to a stage now where we're starting to see property valuations come back to close to the Celtic Tiger period, but only now and only in some areas of the country. But yet you will have seen in the press for the last number of years talk of the growth in Irish property and the growth rates being well above and taking valuations back to pre-Celtic Tiger days, which in point of fact is not true. Okay, so to my next example, when is a declared annualized return of 5%, not 5%? Okay, so let me give you two funds and their performance over a 10-year period. So on the left we have Fund 1, which generates a 5% return each year over the 10 years. And so my average return in percentage terms is 5% over that 10-year time frame. And let me take Fund 2, which over that same 10 years has a slightly different profile in that it loses 20% in year 1. It has a 30% return in year 10, and in the interim has 5% in each of the other 8 years. And so my average return of the two funds is 5%, okay, over the 10-year duration. But in actual fact, what has happened from a valuation point of view is Fund 1 has an outcome of 162,000 odd, close to 163,000, which is a true return of 5% per annum. But Fund 2 has a return of 153,500, which equates to an annualized return of 4.4%. Okay, so the difference between the two is about 5.5%, or just north of 5.5%. And the reason for that is this minus 20% in year 1. Okay, so it's a similar situation to the first problem set that we looked at. Slight difference here is that we've got a 10-year duration and then a pickup at the end. But the point being, averaging percent is not the best way of being able to determine what the actual return to a consumer is. And unfortunately, quite often, the rates that can be disclosed sometimes by different managers can be based on an average of percentage returns, which is not an accurate way of actually presenting this type of information. So it's key to understand what might be happening practically behind the scenes. So moving to my third example. The annual investment return on a rental property with projected capital growth of 2% plus a rental yield of 6% is a total return of 8%, and that should be is it a total return of 8%? And this one actually arose in practice for me. I think it was 18 months, maybe 2 years or so ago. For an individual who was using a well-known piece of cash flow modeling software and trying to reconcile what was going on with the returns, and there's a great scope for misuse of returns when perhaps we're not fully understanding what's going on with the numbers. So let's work through the example. So it's a 300,000 capital investment. Capital growth is 2%, and then the rental yield is on the capital, based on the capital value, is 6%. So on this example, so my 8% capital growth in year one is 24,000, fairly straightforward, and year two, my 8% on the 324,000 brings me up to 25,920. Okay, so if we actually break it down in terms of what's happening at a lower level, my year one breakout, 300,000 capital growth is 6% on that, which is 6,000, and my rental income, which is based on the 300,000 valuation, which is a 6% yield, gives me a rental income of 18,000, which gives me a total return combining the rent and the capital growth of 24,000, which expressed as a percentage of the original 300,000 investment is 8%. So year one, it's true to say that 8% works. It goes wrong from year two, and increasingly wrong each year thereafter. Okay, and this is the key point. So capital growth year two is 2% on the 306,000, which is my 300,000 initial investment, plus the 6,000 in growth from year one. So my new valuation is 306,000 at 2%, gives me now 6,120. My rental income is a 6% yield on the new capital valuation of 306,000, which is 18,360, which gives me a total return of 24,480, which in actual fact in year two represents an investment return of 7.4%. So it's no longer 8%, and is now patently false. Okay. Now, when I looked at this problem set, what we were solving for, in terms of what was being sent to the client, was the client was being given an expectation that an investment into property of 300,000 at the time would give them, after 20 years, an outcome of 1.4 million. The actual outcome would be 883,000. So quite a significant overstatement in terms of that sort of adding together incorrectly of a yield, an income yield, to a capital growth. It doesn't work out. Okay, so again, just an example of where things can go wrong big time, and again, it's just, it's a rule of thumb rather than in terms of adding the two together, the 6 and the 2, or a mental shortcut, whatever you want to describe it as distinct from taking the calculator out and working through the numbers to see exactly what is likely to happen with both the growth and the yield numbers. Okay, so 50%, close to 60% overstatement is the outcome if you get that wrong. So this one is my next example, is particularly related to the management of ARFs and the post-retirement. It can apply in a number of different scenarios, but particularly it relates to ARFs. So this is one where what you're looking at is a problem set where there's a large sum of money to be invested, and there is a need for income to be derived from that particular portfolio, and what does it do over a period of time. And this speaks, in practice, what this speaks to is when we talk about ARF and ARF quotes, we're often, if not always, using quotes that presume a linear progression. And by that, what I mean is, if we, in our quote system, if we're using, say, 4% as the investment growth attaching to the ARF, what the system is doing is saying year 1 the growth is 4, year 2 it's 4, year 3, etc., 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 all the way out for whatever the duration, pardon me, of the forecast is, be it, say, 10, 20 years, whatever it might be. So in effect, what that's mirroring is this scenario sequence 2 here, which is the one we looked at just a few moments ago. But it is this notion that a quoting system, typically, what it does is presumes linear growth of X% each year over the quote period. So we're looking at 10 years here. 5% is the quoted figure, and this problem set works on the basis of it being a 500,000 investment, 5% growth, and the individual is withdrawing 30,000 per annum from that fund. And so what is the balance of the fund at the end of 10 years? And in this case, using that linear growth calculation methodology, it's 365,000, okay? So what I have then either side of this core sequencing model is 2 alternative models. So this one here works on the basis of the investment losing money in the initial couple of years, 2 down years, -10%, -8%, and then we have a prolonged period of a sequence of growth, culminating in a 20% return in the 10th year. So the key thing here is my average return, in percentage terms, is an average of 5% per annum in terms of declared annual returns over the 10-year time frame. So I have average returns of 5% on both sides. It's the same scenario, taking out 30,000, but in this case here, my closing valuation at the end of the 10 years is 256,000. And this side here, we all have the corollary of sequence 1, which is, instead of a 20% gain in year 10, I look at that as happening in year 1. So I start with a positive run, pardon me, of returns, and finish with 2 negatives. So it's the inverse of the first sequence. And the difference is my closing valuation is 420,000 as opposed to 256,000. Okay, so that's quite a dramatic difference between those 2 valuations, where we've got the same sequence, the same valuation of returns over the 10 years, just the sequencing is slightly different in that we're starting with a loss and starting with a gain. And what does it do? So, I'm guessing that a lot of you on the call here today are practitioners. You will straight away see that this is a significant problem for individuals who are retiring and using ARFs as their sole or main type of funding for post retirement. And I know there are merits and debates on the consideration as to whether one uses annuities and the perceived poor valuation attaching to annuities versus ARFs. But what is rarely discussed is this problem of sequencing risk, okay? And it is a defined risk in its own right, which is if the investment returns in the initial couple of years go against you, you can do serious damage to the ARF very quickly. And the problem for most people, not for everybody, but for most people, the problem in working through an ARF structure is you're at a stage of life where you don't have the capacity to regenerate lost capital. Like you're almost fully reliant on the investment markets to regenerate lost capital. And as we've sort of looked at already in some of the earlier slides, where you start with a loss and you need to make back up the gain, it can take a lot longer than you might anticipate to make that gain back up, particularly when you're drawing from the portfolio at the same time. That sort of accelerates the impact. Sorry, excuse me. So So there is a real active management, I would suggest you required around the management of ARFs. It isn't a one-off piece of advice to say, okay, you make a decision as to whether you should avail of an ARF or avail of an annuity, or indeed delay the accessing of pension funds and maybe leaving them sit there until age 70 to avoid crystallizing tax as an option. But it isn't a one-off decision, I suppose, is the key message I'd like to be giving to you. Is this is something that needs managing on an ongoing basis. The problem, I think, is that the structure of our industry is to offer the initial advice, particularly when it comes to ARFs, and that's the end of it. Then, in terms of the need to review the ARF with the client, is not really, there's no motivation really for that to take place or for that to happen, unless you have a business model that is oriented towards the client paying fees or paying a retainer on an ongoing basis, as distinct from upfront commissions as the heavy driver for being paid for service. So it invites consideration, this type of problem set, as to what type of clients we want to work with, stage of life, all that sort of good stuff, and how do we consider business models that are other than ones that are very heavily oriented towards the payment of upfront commissions. And there are many out there, and we talk and explore many of those as part of the program as well, I can say. So what I wanted to say to you, I suppose, just pausing for just a couple of moments, in the context of this type of numbering and sequencing and so on. Again, like we work through this as part of the program. So module 1 in particular, for those of you that are either have registered or are considering registering, we will work through using financial calculators, which are a very different beast to the scientific calculators that most of us are given. To use financial calculators are very, very different and have a great capacity to do calculations for us that are finance related. So what I'd say to you is, part of module 1 introduces those financial calculators and financial calculations. Please, if you're attending or even considering attending, do understand the program doesn't turn you into a mathematical expert. So we don't get into the base formulae underpinning all of these calculations to a great extent. Okay, or I can definitely say you are not examined at the formula level, but there is a need to understand what's happening and how the calculations function, and for that reason there is a consideration certainly of the formulae. But you don't get examined at that level, but you do get examined on your ability to accurately perform calculations, such as targeting of what would you call it, target funding for pension funds at particular ages of retirement, and doing that from a number of different aspects, one being working forward and on the basis of, say, current pension contributions and what the fund is likely to end up looking like, to the inverse of that, which is starting with the goal in mind of having a certain type of income at retirement, and working backwards to say, well, okay, if that's what you want at retirement, how much in capital would you need, and therefore how much would you need to be contributing in order to achieve that, etc. So all of that is considered. It's explored further as part of the risk management module, which is module 2 on the program. So very quickly you're getting into what I would say is practical use of basic financial calculations, and I can say hand on heart, this is a game changer for a lot of people, because what it enables you to do is, while you're sitting with clients, is to work through at a very base level some what if and probability of outcome type calculations, and what if scenarios even, with a calculator. So it isn't a case of having to take information, go back and get quotes run up, etc., etc. It also allows you to have a greater understanding as to what's happening with cash flow modeling software, which pretty much a lot of people are using in practice now, and we'll talk about that as part of the program. And indeed, you'll build your own equivalent of a cash flow modeling piece of software as part of module 6 on the program, and you know, it has a particular purpose in mind, which is to give you confidence in your own ability to understand and interpret financial calculations, to engage with other professionals within the industry, particularly those that will come knocking on your door to say, listen to this about our new product. And quite often what you listen to is a marketing message, whereas in actual fact what you need to understand is what's happening when you remove the marketing message and look beneath the bonnet, what is actually going on within that product. And you will have greater understanding of that, I can guarantee you, as a consequence of coming out of this program. But on into understanding cash flow modeling software, being able to identify where outcomes are not as you would expect them to be, and understanding why that might be the case, or at least go looking for the answers from those that might be able to help you. So that's a key part of the program, and extends into module 6, which is fully advice-driven module. It is all about case studies and one particular project, which is quite intensive, and which involves that ability or need to be able to build out a piece of what you call a financial modeling software. So anyway, that relates what I'm saying here back to the program, hopefully for you. So the next piece I just wanted to have a look at is ESMA ratings, and the use of ESMA ratings. So this is slightly a slightly different angle, I suppose, to what we've looked at to this point. So to understand what we're talking about when we talk about ESMA ratings, which is the measurement of volatility within the fund. And I suppose the one thing I'd say to you, and we discussed this at length during module 1, is when we talk about risk, the use of the term risk has so many different meanings in terms of the investment world versus what the client understands it to be. So if we look at it from an investment world perspective, risk is it's the likelihood of achieving a certain outcome, okay? Whether that's positive or negative, as in a gain or a loss, doesn't matter. It's the likelihood of achieving that outcome. That's what risk is. What's the likelihood of achieving that outcome? Whereas risk, when we mention it to clients, understand that to be, I'm going to lose money, okay? And so that term risk, causes, we're two different types of understanding going on there, and we're not closing the gap in terms of what people understand is going on. So let me attempt to explain using these two fairly simple graphs. So if you look at the notion of an expected return, okay, in practice what often happens is investment funds will have a look back either at the performance of their own fund or of an equivalent mix of, be it stocks or combinations of asset allocation, whether it's, like if I've got to say a balanced fund type profile, so I've got a mixture of equities and bonds and maybe a bit of cash and a small bit of property. If I have my fund in existence for 10 years, I'm looking back at the average of that fund over the most recent 10 years. If I don't have my fund, if it's only a new one, what I'll do is I'll replicate the performance of my mix of assets over the past 10 years, if that makes some sense. But the long and the short of it is, I take those history of 10-year returns, average it, and that's my expected return. And what that means from an investment point of view is that the expectation is that this fund is going to achieve, or most likely to achieve, that percentage of return in the coming years. Now, the first thing implied in all of that is that the investment world of the next 10 years is going to replicate the past 10 years. Okay, that's implicit in this approach. So straight away, what that should hopefully raise for you is, we're now into the realm of, what certainty do we have that the next 10 years are going to be the same as the last 10 years? And the answer there is, it's a very significant unknown factor. So this concept, which is at the heart of investment management, of expected returns, is actually, it's on shaky ground. Okay, but that's my starting point, and this is, this is what happens with investment fund management. So this is not something that's sort of unique to financial planning or anything. So investment fund managers use these principles themselves. So my expected return is the starting point, and then what I want to do is to try and gauge the sequence of 10-year returns. How do they average out around or plot out around my expected return? So if I take my example here, I'm using 14% as having worked out to be the expected return. So on my range of outcomes down here, 14% sits in the middle, and then I'll have, going down this side, I'll have 13, 12, and so on down to 0, and up here I'll have 15, 16, 17, and so on out here. So if the average is 14, it implies, given variability of returns, that some of the returns are going to be to the left of this and some to the right. So in other words, some will be more than 14, some will be left, but on average it's 14%. So the measure standard deviation is a calculation. It's a statistical calculation. It is not unique or a derivative of the financial services market. It is a standard statistical measurement technique that is applied by the investment world to measure a probability of an outcome, which is, if I do my standard deviation calculation using the sequence of 10% returns, in this case here I get a standard deviation of 1.5%. So what that means is that if I remove myself 1.5% either side of this expected return, okay, so 1.5% either side, which gives me a range of 12.5 up to 15.5. The significance of that statistically is that 66.5%, there's a 66.5% probability that next year's return is going to fall within that range. Okay. Now, if I go out 2 standard deviations, okay, 2 standard deviations away from that, which takes me to a range which is going to be between 11 and 17, I now have statistically an outcome which is that there's a 95% probability that my outcome is going to fall in between those 2 ranges. Okay, so now you're getting into probability theory. Okay, so this is then becomes the use of standard deviation. It has in practice then become a measure of volatility within the fund or the performance of a fund. Okay, so the higher that number, that standard deviation number, the more volatile the funds. In other words, by more volatile, what I mean is that the range of returns in the sequence are going to go, say, from 14 right the way out, maybe, say, for example, to minus 14. So there's a broad sequence of returns there, and similarly out here. Okay, and so the bell curve becomes a very flat bell curve, whereas this one here, because it's a low standard deviation number, implies that most of the returns have fit within this very narrow bandwidth here, and so you get a high number of them in the range between 12.5 and 15.5. Okay, so that's the use of standard deviation in theory. Okay, again, what I'll say to you is we cover it in quite a bit more detail and show you how to do the calculation and its use. So what I want to say is the importance of it from the point of view of this morning is just to say to you that standard deviation as a measure of volatility is what is used by ESMA to frame the ESMA ratings, that scale that is 1 to 7. Okay, now here's where we get into, I suppose, what I would call the art of financial planning rather than the science. So this is the science. There's methodology at work here. To my mind, there's an art now required, which is asking ourselves if those bandwidths are the right bandwidths in all prevailing market conditions. And it is found to be the case that they are not. Okay, and so quite early on, we were advising people who were on the program transitioning into CFP designation that in actual fact, a 10-year time horizon is a more acceptable time horizon within which to run these stats than 5 years. And I should say from the outset, ESMA uses a 5-year time horizon for doing the calculations. We have been suggesting from day one it ought to be 10 years minimum. Okay, and that is in fact what the Canadian authorities use as the basis for their calculation is a 10-year time horizon. And the problem with the ESMA scale has been that at different junctures we have ended up with full-blown 100% equity style investments have carried a smaller risk weighting than bond type portfolios, as an example. And indeed have even been on the lower scale, so you're getting them down around a 3 in terms of the risk class under the ESMA ratings. And this is because of just very little volatility in the markets over a particular period of time will cause that particular outcome. And that has happened. And I was fortunate to be in a meeting with ESMA in one of the different roles that I've had over the years, where we did ask for clarification as to why they saw this as a reasonable approach, and their answer was that they felt 5 years was a reasonable time frame in terms of prediction of financial markets. And we were sort of at a loss because at the time that we were looking at it and raised the question with them, we were actually in the heart of a situation where full-blown Irish equity funds were rating 3 on the risk spectrum, which clearly wasn't helpful for clients. So a long way around saying, for the purpose of this morning, and just to say to you, this is something we do cover in a bit of detail, and it's an example of the nature of the way we cover material. It isn't that we have all of the answers. Oftentimes what your lecturers are doing, and they are all practitioners, so let me say that up front, all of the lecturers are practitioners in different shapes and sizes and give you slightly different perspectives, and that's a great advantage also. So it allows you hopefully to identify that some of what we sort of rely on so much as being hard and fast rules that the industry is built on, in actual fact the foundations are a little bit ropey, and sometimes we need to have structured ways of operating outside of those hard and fast rules, and that carries risk, and again something we look to educate you on in terms of how you might manage that, because it does require a professional discipline, and leads by extension then into conversations around what does it mean to be a professional practitioner, whether you're a financial planner or a tax advisor or whatever. What does it mean to be a professional practitioner? And there are some things that need to be considered in that space by all of us if we are truly going to move the practice of financial planning up the scale in terms of the being seen and accepted as a profession. Okay, so enough on ESMA ratings, and the very last one I just want to touch on because it's endemic in our industry, which is the use of 4 times salary as a recommendation for life insurance, which I personally believe is deeply flawed, and there are I know arguments put forward as to why it ought to be acceptable in the absence of doing analysis. I disagree wholeheartedly, and I actually think we are, as professionals, we are obliged, almost in my view, to carry out an in-depth piece of research as to what level it is that a client needs in terms of life insurance, what type of life insurance, whether it's term, whether it's declining term, and so on and so forth. What is it that the client needs? Because the risk that we run with this is the 4 times salary rule can end up with a client being completely overinsured, possibly underinsured. It doesn't take account of anything such as the fact that the client can have substantial net disposable income. So if we're covering 4 times salary, we're covering surplus income that's going into other uses, be it lifestyle, be it savings, etc., etc., and that's not the function of life insurance at all. So you know, what's the debt profile? How is that covered? Is it covered slightly differently to the need to protect family and so on? So there are a whole range and issues associated with life insurance, which, to my mind, warrant an approach that is a bit more structured than just simply taking 4 times salary. It carries the risk that overinsurance, there's a cost going into that insurance, which could be used, say, for example, for the accumulation of funds for kids' education, say, as one example, presuming that the 4 times salary is an overinsured outcome. So So that's it from me from this morning. There are a couple of questions which I'll just have a quick look at there. So the first one is in terms of the retirement planning module. Does the course cover all potential changes in the retirement planning landscape? And the answer to that is yes, all known changes are definitely covered, but we also posit what could possibly be changes in the future. And obviously what you need to keep in mind in here is the role of the lecturer. We are not going to be able to answer categorically what the landscape is going to look like out into the future. But one of the things we do challenge you to do and to consider is that the landscape or the environment within which financial planning is conducted is a constantly evolving and changing environment. And we need to be aware of those changes, and we need to have the skill set and the understanding to be able to say, perhaps there's something that we ought to be doing here for clients. A simple example might be a piece of what if analysis. So in other words, if we have some sense of retirement planning changing in some way in the coming years, that we can very quickly do a calculation to say, and oh, by the way, if this does happen, this is going to be the impact that it would have on your retirement planning intentions. I hope that answers that question for you. If not, come back to me either now or at some stage through LIA, and I'll happily come back to you on that. Wondering what level of Excel knowledge is required for the program. Yeah, listen, that's a great question. What I'd say to you is you need to have a working knowledge of Excel by the time you get to module 6, which is 18 months out. Having said that, it is that you're able to organize data into a table, and by that I mean just columns and rows, and that you're able to do the basic maths of add, subtract, multiply, and divide on that data. We'll show you some rinky-dink formulae that you can use. It's not critical. It will help you with shortcuts in some of your analysis, but it's not. You'll still be able to do it using just the basic financial maths calculations, if that makes some sense. So that's what I would say to you there. I do recommend to people, if you haven't done it and if you have no experience of Excel or indeed Word, an ECDL program would be something that you could consider taking on in advance. And Eva, I think, might have some recommendations from an LIA perspective in terms of other business courses that are available that give you an understanding of basic functionality within Excel. I should say to you also that when it comes to module 6, I do run a lecture which is fully recorded, and you'll be able to refer back into time and time again, which focuses on the use of Excel. Okay, so for the purpose of this module, so it's very much honed on the things you need to be able to do for the module, as distinct from a very generic, here's how Excel works. I don't bother with that stuff at all. It's just, here's what you need to be able to do and how you do it. It's recorded. All the keystrokes are there for you to be able to look back on. So that will happen, and hopefully that gives you a level of confidence. Are the modules dependent on taking them in a particular sequence? Can I do modules 3 and 4 before 1 and 2, for example? The answer to that is yes, you can. Short answer. I would say to you, ideally take module 1 first, only because module 1 is quite broad and sort of introduces you to each of the other modules by degrees. But having said that, it will definitely not compromise you taking modules 3 and 4 first. So that's short answer for that one. And if you commence in September, how soon can you be certified as a CFP? So commencing in September, and presuming you do 2 modules per semester, you'll have 1 and 2 done by Christmas. You'll have 3 and 4 done by next summer of 2022, and then you'll have modules 5 and 6 complete by Christmas of 2022. So all of the program will be fully complete by Christmas of 2022, and then in February of 2023 you do the CFP examination, which is a completely separate exam. So understand, this is the education program that underpins the CFP program. As a professional body, the Financial Planning Standards Board has its own professional exam. It's not a new course. In effect, module 6 of this program prepares you for that exam, and that is a 3.5-hour exam which will take place in February of 2023 for you. And then there's an application process to the board of FPSB, and you'll start to use it from June 2023. Now, if you do 1 module per semester, which some people may elect to do, it obviously pushes that time frame out by another 18 months or thereabouts. So it would be 2023, so you're looking around 2025, I think, if my maths is correct on that one, to before you get to CFP. Okay, I think is there? Oh, there's another one down here. Sorry, I missed that one. If you can only do one module per period, what's the best way of doing them, particularly with regards to the quality before you have completed the course? Yeah, listen, Oren, my own personal advice to you would be that you start with module 1 and take that this coming September. Then you can use either modules 3 or 4 in February. You know, each has its own designation. So the SSIA, or sorry, the SIA for the investment, or the RPA for the retirement. So you make a decision on that. You know, there's no difference, if you know what I mean, in terms of advantages. It depends on what your core strength is. I would suggest to you, and where your best interest lies, to which one of those you might take. Then you take module 5, which is the tax planning module, the following September, and then obviously you just finish out the other ones during the following 3 semesters, if that makes some sense. So that would be my advice. The only real difficult decision will be whether you take module 1 or module 2 in September. My guidance would be module 1, just because it covers off elements of the other modules, or at least lines them up, if that makes some sense. So I think that's they're all of the questions dealt with. I'll say thank you for your attention this morning. If something does come up where you need to have a chat with me, reach out to LIA. They have my contact details. I'm more than happy to either speak to somebody directly or whatever is needed, if it helps you in terms of making a decision on the programme. And listen, I look forward to seeing you all in September for the first lecture of Module 1. Thank you.
Great, thank you, Paul. That was brilliant. That was a really thought-provoking lecture. So, and thank you to everyone who tuned in today. If you would like any more information about the Postgraduate Diploma, as Paul mentioned, please reach out to us. I provided contact information on screen from my colleague Brian Dunphy, and he'd be more than happy as well to discuss the programme with you and answer any questions you might have. Brian actually himself is a CFP. So he's been through it and he's come out the other side, so he'd be a great person to talk to and answer any questions you might have. Just, I suppose, in relation to the programme timetable for Term 1, Module 1, the Principles and Practices of Financial Planning, will be commencing on Monday the 6th of September. It'll be an evening lecture from 6 until 8:30. And then Module 2, which is the Risk Management and Insurance Planning module, that'll commence on Thursday the 9th of September. And again, it's an evening lecture from 6 until 8:30. And for anyone who is commencing the programme with us in September, we will be in touch with you to confirm timetables, how to access your learning resources, and all that you'll need for the lecture. As Paul mentioned about Excel and Excel courses, we will have an Excel webinar for you ahead of your lecture. So we'll be sharing that with you as well to get you started before you start the